Hello everyone and welcome back to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are revising chapter 10, which is cost of capital. So over here we try to find out, and learn the formulae with which we are able to calculate the cost of different sources of capital, equity as well as debt. So let's get started. Number first that we learn is going to be the dividend valuation model. So DVM model, there are multiple possibilities over here. So first possibility is if you have a constant dividend. So in case of a constant dividend, your P0 is equals to D upon RE. So over here, P0 stands for your current X dividend market price. Then D stands for the dividend. And then RE stands for the required rate of return of the equity shareholders. All right, so this is the formula that we use if a constant dividend is being paid out every year. That means if $5 has been decided as the dividend which gets paid out every year, regardless of what profits are, what the growth is. So this is the formula that you're supposed to use. Then the more likely scenario is that there's a constant dividend growth. So every year your dividend is growing by a fixed percentage. So what formula do you use in that case? P0 is going to be equal to D0 into 1 plus G divided by RE minus G. G over here stands for your growth rate. Now D0 is your dividend today, dividend in the current year. Now if you add to it the growth, basically you're converting it to the dividend which will be paid in the next year. So you can also rewrite this formula as D1 divided by RE minus G. So this is the formula that you can use to find out the price or the cost of capital if you have a dividend growth scenario. All right, so if now how do you work out this growth rate? Now for calculating this growth rate also we have multiple ways through which you can do that. So number one method is the extrapolation method. How do you work out the growth using the extrapolation method is that you take the oldest dividend multiplied by 1 plus G raised to the power n gives you the newest dividend. So this is the formula. Now to simplify it, to bring it to, just to calculate G. So it's going to be 1 plus G equals to the root, and the root will be raised to the power of n. So which root will it be? That n determines newest dividend in your numerator, oldest dividend in your denominator, and this gives you 1 plus G. So how do you work out G? This entire thing, and then you subtract 1, so you work out G. This is how the growth rate can be estimated if you're using the extrapolation method in a scenario where you are given the dividend information for multiple number of years. So then you can use the extrapolation method. This is the first method. The second method to calculate the growth rate is your Gordon's growth model. So this was a model given by a person named Gordon, hence the name Gordon's growth model. Now, how does this work? It gives you another formula. Now, G, according to this model, is equals to BR. What are B and R over here? B is nothing but the retention ratio. B is your retention ratio. What do you mean by retention ratio? Out of the total profits that the business is making, how much is the business actually retaining in the business? So that is what you call as the retention ratio. If you have the payout ratio given to you, you just subtract, 1 from the payout ratio, and then you will have the retention ratio. That basically means if 1 has been earned and 0.7 is given as dividend, 0.3 is retained, so retention ratio becomes 30%. So this is how you work out retention ratio. The formula for the same can also be written as retained profit divided by PAT. So this gives you the retention ratio. And then the next variable that you need to learn is R. So R over here is nothing but the rate of return on profits. Rate of return on retained profit. So how much is the business actually able to earn on the profits it actually retains on the business? So how do you work this out? You take the profit after tax and then you divide that by the shareholders' funds. So this is how you can work out the R over here. You multiply both of the things and then you will have the G, which is going to be the growth rate. So this is how Gordon's model gives you the formula G equals BR to work out the growth rate, and then you can use the formula which we have written above for the growth model, and you can use that formula to work out the numbers. Now let's get ahead. The next thing that we are going to learn is going to be the cost of your preference shares. So how do you work out the cost of preference shares? So it's a simple formula. Your KE, or you can better rewrite it as KP, is going to be equal to your dividend divided by the price. So this gives you the cost of preference shares. Now the next thing that we need to learn is going to be the cost of irredeemable loan notes. How do you work that out? So that is going to be equal to KD is equals to I divided by P0. So over here, I is your interest and P0 is nothing but the price. Now please note that the KD over here stands for the pre-tax cost of debt. This is nothing but the pre-tax cost of debt. If you want to convert it to post-tax, you have to do post-tax is equals to pre-tax into 1 minus the tax rate. T over here stands for your tax rate. So this is how you can work out the post-tax cost of irredeemable loan notes. Now the next thing that we are going to talk about is going to be the cost of redeemable loan note. So if you have a redeemable loan note, how do you work out the cost for the same? It's a very simple thing. You just have to take out the IRR. IRR of what? Number one, you will take the current market price. Current market price, and then you take it as a negative figure over here. And then for the further calculations, you're going to take the interest, and this interest is supposed to be the post-tax interest. This always comes in positive figures. And then for all of the years that you have interest, make sure that you charge it for that. And then you're going to take the post-tax interest plus the redemption value in the last year. So if the redemption is 100 and your interest is, let's suppose, 4.5, so 104.5 is what you're going to write over here, and then you simply put the IRR function, and then you will have your cost of the cost of redeemable loan notes. Now the next thing that we are going to study before we move to the next thing, you should know that the examiner can very well play with words, so you should know what different terminologies are also used for the same thing. So if you talk about the pre-tax cost, so it's nothing but the required rate of return of the redeemable debt holder this required rate of return can also be called as the IRR of pre-tax cash flows. So over here you took the post-tax cash flows, but if you convert it, if you just take the pre-tax values over here, then it becomes the required rate of return of the redeemable debt holder. So another name which you can mention over here can be the IRR of pre-tax cash flows. Now, another name could be gross redemption yield. And another name for the very same thing is also called as the yield to maturity. All of the things are supposed to mean the exactly same thing. So if at all examiner is using different terminologies, make sure that you do not get bowled out and you know that these are the terminologies which mean the same thing. All right. So this is something that you will use for the pre-tax cost of debt. All right. These are the names for the pre-tax cost of debt. So we move ahead. Now, there is also a possibility that in the real life, what is more practical is that the interest that the companies pay on these, debt instruments, rather than being an annual payment, it's more of a semi-annual or a quarterly payment that the company does. So if at all you have some scenario like this where the interest is being paid quarterly, or twice in a year, like 6 months gap. So what is the adjustment that you will make to find out the cost of capital is that if you have a semi-annual interest. All right, so if you have a semi-annual interest, there are two steps that you're going to follow. Number one step over here being that you have to calculate the IRR based on cash flows which are on the monthly interval. So let's suppose these are your values. You put the current one as negative in year 0. Now in year 1, whatever is the interest, so let's suppose the interest is being paid twice. Let's suppose there's an interest of $6 and $3 each time it is being paid. So you're going to put it as 2 separate years, and then you calculate the IRR. This is going to be your step 1. And the step 2 that you're going to follow is that once you have the IRR all worked out, once you have worked out the IRR, the second step that you will do is that you will find out the annual effective rate. I'll just give you the formula for the annual effective rate. How, once you have worked out the IRR using the step 1, using them, taking them as 2 separate years if there are 2 payments, and if there are 4 payments, you will take 4 years. So this is how you can bifurcate the payments, and then you can calculate the IRR. And then the step 2 over here will be to calculate the effective annual cost. So once you have the IRR, step 2 is going to be annual effective cost. And how do you calculate that? It's going to be equal to 1 plus the semi-annual cost raised to the power of 2 minus 1. Now, if at all it's quarterly, then you will raise it to the power of 4. If at all it is monthly, you will raise it to the power of 12. So the number of times the interest is being paid is what you will raise the power to. Over here, there are 2 interest payments in 1 year, so I've raised it to the power of 2. So this is how you calculate the annual effective cost. Now let's learn about convertible loan notes. So how do you find out the value, the cost of a convertible loan note? So over here, you just have to calculate the IRR of cash flows, similar to what we were doing earlier. But over here, because this is a convertible, what you're going to do is you're going to take the current market price, put it as a negative figure. You take all of the post-tax interest as a positive figure for all of the years that you have the interest. Once you have done that, then for the end year where the redemption is going to happen, either redemption or conversion. So basically, you're going to take the higher of redemption or the conversion value plus the interest, the post-tax interest, whatever that is, and then you calculate the IRR. So this is how you will be able to find out the cost of a convertible loan note. Now moving towards the very last thing, which is very easy, which is to find out the cost of a bank loan. Now whatever is given to you in the balance sheet as the percentage cost written next to a bank loan is what is your pre-tax cost. Now this is also called as the quoted interest rate. Quoted means this is the interest rate which the bank has given you the loan on. So this is called quoted interest rate. This is nothing but your pre-tax cost of bank loan. This is given to you as a percentage in your balance sheet or whatever financial information you have available. Then how do you convert it to a post-tax cost? It's simple. The formula that we have learned above also, post-tax cost is going to be your quoted interest rate multiplied by 1 minus tax rate. So if you just do this adjustment, you will have the post-tax cost of your bank loan. Why is this adjustment done? Because we get certain tax benefit because of charging interest on our profits, tax is only paid on profits which are left after the interest has been paid. So by paying interest, we actually reduce the profits and we reduce the tax payment. So this is why there's a tax benefit that we get on bank loans, and hence to calculate the post-tax cost, we just multiply it with 1 minus the tax rate. This is how you will arrive at the post-tax cost of a bank loan. With this, we are done with chapter number 10. I will catch you in the next video for the revision of chapter 11. Thank you so much for watching. I hope that this was useful.